So now we have another requirement, and that is explained with calculations how the sale of inventory would be accounted for in the individual financial statements of both Jacinta company and the overseas subsidiary at 1st September 2006 and the consolidated statements of Jacinta Group at 31st December 2006. So sale of inventories, on 1st September, to Jacinta company sold inventories costing 1.35 million to the wholly owned overseas subsidiary for 2 million. There is no right of return. The subsidiary has the euro as its functional currency. The exchange rate on the date of the sale from Jacinta company to the overseas subsidiary was 1 is to 1.25 at 31st December X6. The subsidiary still holds gold inventories and the exchange rate is 1 is to 1.3. There is no intercompany debt outstanding standing at the year end, and we have to explain with calculations about the sale of inventories how would be accounted for in the individual financial statements of both Jacinta Co. and the overseas subsidiary at 1st September 2006 and in the consolidated financial statements of the Jacinta. Okay, so that's it. Anything else from the scenario? No. Just let's move to the drafting, and that's our last part of the question. That is sale of inventories. And first, Jacinta company. First heading, Jacinta company at 1st September 2006. When recording the sale of $2 million, as revenue on 1st September 2006 and the cost of the inventory. So, yeah, and the cost of the inventory and cost of sale of dollar 1.35 million. Jacinta company has realized profit of how much? That is 2 million minus 1.35 million. We get dollar 650,000. So in its individual financial statements. Okay. Now the next heading, the subsidiary at 1st September X6. Okay. What we will say that subsidiary has recorded the cost of the inventory at 2 million into 1.25, that is 2.5 million at 1st September 2006. The cost of the inventories includes the original cost to Jacinta company of dollar 1.35 million into 1.25 million. We got euro 1,687,500 plus the intra-group profit of intra-group profit of dollar 650,000 into the rate, the exchange rate 1.25 will get euro 850, sorry, 812,500. Charged by Jacinta company. Now we are moving towards the end. On, on consolidation at 31st December 2006, the intra-group revenue and cost of sales should be eliminated the intra-group profit of dollar 650,000. That is, the euros of 812,500 is also eliminated. As the inventories have not been sold, as the inventories have not been sold, and the profit is not realized outside the group. Finally, when the subsidiary company financial statements are translated into the presentation currency of the group. The cost of inventories of euro 1,687,500 is translated at the current exchange rate. Current exchange rate at 31st December 2006 and inventories of dollar 1,298,077. That is, the same. Uh, the euro 1,687,500 divided by 1.30, the exchange rate, are recognized in group statement of financial position. Therefore, at 31st December 2006, Jacinta Group will recognize loss on exchange on inventories of 1.35, sorry, yeah, dollar 51,923. That is, 1.35 million minus 1,298,077 as part of the translate as part of the translation reserve associated with the subsidiary company, because the subsidiary company is wholly owned, there is no non-controlling interest. So far, so good. I hope you get it. And we are done with the whole question now. If you have any questions, you can ask me on my WhatsApp anytime. That's it for now. Bye bye.